$100. The Strait of Hormuz sits between Iran and Oman, linking the Persian Gulf to the Arabian Sea. It's the most critical choke point in global oil and gas trade, handling some 20% of global oil consumption. Most tanker owners have reportedly suspended shipments after Tehran warned ships against moving through the waterway, and amid reports of at least 3 ships being attacked near the strait, injuring multiple on board. But the narrow choke point is not completely closed. Some Chinese and Iranian vessels are reported to have passed through. About 3/4 of oil exports that pass through the strait go to China, India, Japan, and South Korea. And to talk about market implications, we've got Yap Fu Kien, Senior Investment Strategist for Wealth Solutions Division at Standard Chartered Bank. Fu Kien, so a lot of focus, of course, in the impact on oil prices. Where do you see energy prices headed now?
Yeah, thanks very much. I mean, we have a scenario, a base case scenario, where very much like the middle of 2025, we can see the WTI heading towards $80 in the short term. But thereafter, we do expect hope as well that this will be a shorter-lived conflict. And then after that, it can, after going, spiking up to around $80, maybe it can then fade towards $60 over a 12-month view. Just because the market is still very oversupplied. And so we see it going down to 60. But in the short term, I think, as you guys have been reporting as well, the Strait of Hormuz is at 20 to 25% of global crude oil exports. And so that is a possibility, could go up to $80 in the short term. I mean, there is another scenario as well. It's not our base case, but possibly that if parties come together and negotiate, we could see oil coming off towards $60 in the short term. And another less favorable scenario would be it's a more prolonged conflict. Then you can see oil prices staying above $80 for a more prolonged period. But as I said on our base case, that there'll be a shorter-lived spike, and then it will be coming down after that.
All right, so a short-lived spike is what you are expecting. And of course, the focus is what this will mean for the global economy, because some strategists are now warning of higher inflation with growth that is not catching up and not rising. So how much of a risk is stagflation in your mind?
Yeah, I mean, oil price is a very, very critical component for inflation. It is a concern because the world in the last few years have been dealing and coping with high inflation. And it is coming off now, which has actually enabled central banks to cut rates. If we do see a prolonged oil prices, then yes, that could have an impact on inflation, and that would inhibit the Fed's ability to cut rates in the US. And yeah, that would have an impact on the economy as well. I mean, our base case scenario is still that inflation is coming off in the US. We see especially shelter inflation or housing that is coming off. And that will then enable the Fed to cut rates by 75 basis points. But look, I think the events are unpredictable. And geopolitical events like this, I think since the start of the year, there's been an upside surprise in terms of the number of events we're seeing. So we would always tell investors to be diversified in your investments in an equity and bond portfolio. And gold as well is an asset class that is very important. We are overweight on gold ourselves. We would say in a balanced portfolio for investors with moderate risk profile. Having 6% allocation to gold is what we recommend. And it's actually a very good hedge against geopolitical events, against inflation and recession risk as well. So having a diversified portfolio is definitely critical to build your wealth.
Yeah, and I want to talk about Asia specifically, because before all this, Asia was already dealing with, threats to its exports, uneven recoveries. How much of this Middle East situation do you think will affect not just the Asian economies, but Asian markets as well?
Yeah, I think if you look at big markets in Asia like China and India, being oil importers, again, that would impact operating costs. That would impact concerns about inflation again. So it very much comes back to whether this is a prolonged event or a shorter-lived event, as we hope in our base case. In which case, then it will be manageable. Especially in China, we see that they're running up into their two sessions meeting coming up when they will start. The CNPC will start on the 4th or 5th of March, and then they'll be discussing. Now, we do expect them to set a GDP target of 4.5% to 5%. And when they do that, we can expect them to roll out policies as well to keep growth stable. So we do expect policies in China to be available to keep growth stable. But yes, in the short term, clearly, I think all the major economies in the region will hope that this is a very short-lived conflict. But if it is a longer, and we do expect there's policy response that can help to keep growth stable.
Yeah, you were talking about gold, Ken, and that could, highlight how much investors are moving into safe haven assets in the midst of all this risks. But I'm wondering about the U.S. dollar, because before this, there were questions about its safety. Now, what role does the U.S. dollar play in terms of, being a safe haven asset?
Yeah, that's a great question. I mean, the U.S. dollar has historically been a safe haven asset. I think we saw a weakening in January, especially when events around Greenland was like picking up and news around that. There's a lot of uncertainty. I mean, we do expect the U.S. dollar index, the DXY, if you like, to weaken to around 96 over the next 12 months. So it has weakened a bit already, but we do expect it to come off a little bit. And part of that as well is because of the Fed rate cuts that we do expect, especially in the second half of the year, as they are expected to, we believe, cut rates by about 75 basis points or 3 times. They'll be putting pressure on the US dollar coming down. But look, I mean, the US dollar as a reserve currency, there's not much alternative at the moment. So we do expect that will stay, but there are economics there. There are some uncertainty there. That's why we think the US dollar could weaken to around 96 over 12 months. And being diversified in something like gold, especially, is important, because we do see a lot of central banks diversifying their reserves and buying gold. And that's why we do see structural demand for gold. Even though it's done well, we do expect that to continue to do well. But DXY going to about 96.
Okay, we'll watch that closely. Appreciate it. Yeah, Ken there, Senior Investment Strategist, Wealth Solutions Division at Standard Chartered Bank.